Hello, everyone. Welcome back to another edition of the Weekend Charts. Charlie Bilello here. I'm your host, and as always, I'm going to run through some of the most important charts and themes that I'm seeing in markets today. A lot on the docket today, a lot to talk about. We're going to discuss NVIDIA earnings, of course. The AI show goes on. Booming utilities, housing market gridlock. Jamie Dimon had some interesting comments that he made on credit spreads and buying back his own stock. Roaring Kitty says goodbye, so as quick as he came, he's gone once again. Trouble at Target. We'll talk about the earnings there, and we'll end, as we always do, with something positive, and that's a great start to the year for the U.S. equity market. All right, number one here, the AI show goes on. This is kind of unbelievable because expectations were so incredibly high entering the NVIDIA earnings report, but they beat once again, top line, bottom line, and the stock jumped once again to all-time highs, crossing above $1,000 per share for the first time. And here I'm showing you NVIDIA's quarterly revenue. You can see the exponential growth over the past year. We're talking about growth from 7 billion a quarter ago in 2000, a year ago in 2023, and today up to 26 billion. So just phenomenal record quarter once again, and they're expecting this growth to continue. In Q2, they're expecting 28 billion. And if we look at the year-over-year numbers, 262%, just crazy growth over the past year. And if the estimate from NVIDIA is correct, that's finally going to start to show some deceleration here in terms of Q2. They're expecting still a double, 107%, but a little bit of a lower growth rate. So it's finally showing some signs, I guess, that the numbers have gotten so big that it's difficult to continue growing at the pace it's been growing. So net income, bottom line, enormous increase over the past year. Talking about going from 2 billion a year ago to nearly 15 billion in quarterly net income. So just an amazingly profitable company, and big reason for that is that there's such enormous demand and the competition just isn't there just yet. NVIDIA still controls over 80% of the market, so they could pretty much charge whatever they want for these products. And you could see that in their profit margins here, expanding up to 58%. That's another record high in the first quarter. Just amazing number in terms of being able to increase their top line as much as they have over the past year, but also increase their profit margins as well. So here's the big question for NVIDIA. It's in terms of their biggest customers. If you look at the cloud businesses, Apple, Google, Microsoft, Amazon, they're spending about $10 billion, it seems like, from the last quarter here. About 45% of NVIDIA's data center revenues coming from these big cloud companies. So the big question is, they're going to be spending obviously a ton over the next year, over the next few years, building out this AI infrastructure. And when will they start to develop their own chips? Well, all of them, the biggest players, Amazon, Google, Meta, and Microsoft, they're all investing heavily in R&D, trying to come up with building their chips of their own to get away from this dependence on NVIDIA. So the big question is, how long is that going to take? Is that going to be meaningful enough to make a dent in NVIDIA's business? But it's not a risk that's unknown at this point. So I guess it's coming. It's only a matter of time. The question is it going to happen next quarter? Unlikely. Is it going to happen a year from now? Perhaps. I don't know how long it'll take to try to become a player in these types of chips. Obviously, it's extremely complicated. Otherwise, NVIDIA wouldn't have the market share it will have. So that's the big question. These big fat profit margins are someone else's opportunity. And if we look at the biggest spenders here, well, they're all spending so much money on R&D already. Well, why not try to invest in that infrastructure and try to build out the ability to make these chips on their own? So we'll see what happens with that. But year to date, NVIDIA obviously crushing it, up 110%. And if we look at the opposite end, Intel, I think, is the worst performing stock in the S&P 500 in the semiconductor space. So it's not a rising tide that has lifted all semiconductor stocks. NVIDIA up 110%, Intel down 40% year to date. So if you don't have the type of growth that NVIDIA is showing, if you don't have that AI business that NVIDIA does, you're not seeing the performance whatsoever. Obviously, NVIDIA in a class of its own. There's nothing else within the space, even looking at AMD, showing anywhere near the type of growth that NVIDIA is showing. And if we look at the chart, and this is what I like to look at between returns and revenue to get an idea is, has the stock run up already ahead of expectations? Well, we're in May here. The stock's up 110% year to date, and the expected revenue for the entire year is an 85% increase. So it's already exceeded that in terms of the growth. So the question is it going to continue to beat on the top line? Will this number end up being much higher? And is there still room for the stock to grow in the months to come? So this is an interesting one that I pointed out last quarter, but the gap has widened significantly here. NVIDIA at $2.6 trillion market cap. It's only trailing Apple and Microsoft in terms of the biggest companies in the US, but it's actually almost $900 billion higher than all of the companies in the S&P 500 energy sector combined, which make up around 1.7 trillion in total. Now, here's the interesting thing. NVIDIA's net income, 43 billion. The energy sector companies combined, 128 billion. So if you look at this, you say, well, how is this trading at such a premium market cap? And what people will say is it's because the expected growth for NVIDIA is just so enormous. It's expected to double or triple, I guess, in the next decade at least. And that justifies it trading at a premium valuation. But just something very interesting showing you the difference in the expectations for NVIDIA versus something like an entire energy sector. NVIDIA obviously trading at a much higher multiple of earnings and of sales. So if we're looking at the last 10 years for NVIDIA, unbelievable, tremendous fundamental growth. Pretty much no other company of its size has ever done this in the history of public markets, where it's grown its revenue 1,700%, net income 7,900%, and its stock price here over 23,000% increase over the last 10 years. Far and away the best performing a stock in the S&P 500 over the last decade. But you can see the disparity here. It's not one for one in terms of net income and stock price. And that just means that there's been a multiple expansion, as you would imagine there would have been over the last 10 years. And why has there been a multiple expansion? Well, investors today are expecting a much higher growth rate than they were 10 years ago. And if we look at NVIDIA, price to earnings, price to sales, no one near them in terms of the other big tech companies, 32 times sales trading at. Microsoft second here at 14 times sales. Again, the expectation is NVIDIA is going to grow into that 32 times sales by continuing to increase its top line growth. If those growth numbers fall short of those expectations, well, now you have vulnerability in terms of earnings. NVIDIA trading at almost 60 times earnings. So just unbelievable in terms of it's had these multiples over the past year and it's been able to grow into them by continuing to beat expectations. And if we look at NVIDIA versus the enormous 8 that I've called them here, NVIDIA just in its own league, 110% gain on the year versus 32% for Meta, which is in second place. And you actually still have Apple and Tesla down on the year. Apple down 3% and Tesla down 30%. So not evenly distributed in terms of the returns of the biggest US companies. NVIDIA far and away the leader here. And that kind of goes with its growth rate. No one's close to having a 260% increase in revenue over the past year. And if we look at what else the AI boom has translated into, well, this is a very interesting one that I didn't hear anyone talking about last year. Now people are starting to talk about because the prices have moved, but the AI boom has not been limited to just tech. Now it's translating into a boom for, you guessed it, utility stocks, which are traditionally known as the most boring sector in the S&P 500. And if we look at the top performing stocks in the S&P 500 as of last week, utilities, 3 out of the top 5 are electric utilities. Got Vistra, Constellation Energy, and NRG. Enormous increases this year. And the utility sector is actually outpacing the tech sector on the year, something I don't think anyone would have expected entering the year. And certainly you wouldn't expect this in a bull market and a very strong year for the markets, where utilities are outperforming the S&P 500 and the tech sector, 15% gain versus 10% for tech. Why are utilities experiencing this boom? Well, it's always about the story and the narrative. And the narrative is that we're going to see a huge increase in the demand for electricity over the next 7 years. Goldman's estimating 15% per year in terms of power demand increasing because of the AI revolution and how much of increase in demand that there's going to be for electricity. So these are very demanding components. If we look at the AI data centers, they eat up a lot of electricity. Maybe that'll change at some point. So the expectation is we're going to need a lot more power demand in the next power supply in the next 7 years. So currently today, these data centers make up around 3% of U.S. power demand. And in 2030, 7 years from now, we're looking at 8% of total U.S. power demand. And what some are comparing this period to is the 1960s and 1970s when we had really wide adoption of air conditioning take place, and that led to a huge boom in terms of electricity generation and demand. So we'll see what happens with utilities. Very interesting to see that it's not just limited to semiconductors and technology stocks. We're also seeing now the boom affect a typically boring sector like utilities. Number three, housing market gridlock. This is a story that I've been talking about for the last 2 years, and it really continues here. We're talking about now the 32nd consecutive year-over-year decline for the number of existing U.S. homes that are sold in the U.S. Prices, unlike the period from 2007 to 2009, where we also had a long period of declining existing home sales, prices are not going down, but they're going up. If we look at Redfin's real-time data here, median sales price of a home sold in the U.S. is actually 4% higher than a year ago. The existing home sales data from April was up almost 6% year over year. And so we're seeing that same phenomenon that I've been talking about, where not enough existing homes for sale to meet that demand. So even though demand has come way down because affordability is so low, you had supply constrained to the point that prices actually are still going up. And so unless that kind of dynamic changes, the housing market is kind of in this stalemate where activity is very low and prices are actually rising a little bit from year over year levels. If we talk about new home sales and what's driving the new home market, we're looking at here the housing market index, which is a measure of home builder sentiment. And you can see here dipping back down this month, which means that home builders less excited about increasing activity. And when it's below 50, less excited, above 50, more excited. And you can see a little bit of volatility here over the past year. And a lot of what's driving that is changes in interest rates, changes in that 30-year mortgage rate. So as we started to go back above 7%, we saw this index dip below 50 again, and more home builders talking about that lack of affordability. And if we look at the supply of new homes for sale, very different in the new home market than the existing home market. Existing home market still very low supply, but if we're talking about new homes, actually 9 months of supply, which is pretty good, highest we've seen since November 2022. So in terms of new home prices, we've kind of seen sideways action here over the past few years. 506,000 today, really no different than it was a few years ago. So we kind of seen sideways action, but you can see here that doesn't make up for this huge spike. So huge increase in new home prices you saw in 2020, 2021, and early part of 2022. And now we've just gone sideways pretty much over the last 2 years. Here's the big thing affecting new home market. Same thing as the existing home market is the fact that affordability is so low. Here I'm showing you the difference between 3 years ago and today. 30-year mortgage rate just 3 years ago was 3%. The average new home price back then was $427,000. If we look at today, 30-year mortgage 7%, average new home price has moved up to $506,000. So we have higher mortgage rate, higher home prices, and what that leads to is you need a bigger down payment to afford that home because the home price is higher, and your monthly payment, this is obviously the biggest one, because of that higher mortgage rate and the higher price, is now 87% higher. So you're talking about a huge jump in terms of what you would need to afford that new home in the U.S. And what that's leading to, we've talked about, is home builders building smaller homes, offering more incentives, a lot of different things. But what this is also causing is home builders to be very cautious and hesitant about building a lot of new homes. So we're seeing things like housing starts and building permits really been stagnant over the past few years, not seeing a big uptick in activity, even though we need more homes. They're as long as they're not affordable, the builders don't seem to be willing to go out and build, and the cost of building, because of inflation and because of high interest rates, is really prohibitive as well. So new home market similar to the existing home market, but we have a little bit better in terms of supply. And what I've talked about in the past year, it's very interesting that if you look at the share of new homes as a percentage of all homes that are for sale, we're still near record high. So about a third of the homes that are for sale in the US are new homes. That's much higher than you typically see because you have all of those existing homeowners on the sidelines waiting for interest rates to come down so that they can afford wherever they're going to move to next. And here's an interesting one, interesting data point here. We have annual home improvement spending in the U.S. It's expected to dip down to 449 billion this year from last year's record $481 billion total. That would be, if that ends up happening, the first decline in spending that we've seen since 2009. So finally, we're starting to see this impact in terms of the consumer. We're seeing this housing market activity decline. And because people aren't moving as much, there's not as many new homes being built. Well, you don't have as much spending on people spending on their homes. And obviously, there was a huge boom in terms of spending, especially during COVID when people were home more and during that stimulus. And now we're actually seeing the opposite. And we've been talking about in terms of Home Depot, other retailers seeing the impact of this on a year-over-year basis now, 5 consecutive quarters where Home Depot's seen a negative year-over-year decline. So whether you own a home or you're looking to buy a home, you're thinking about housing as a part of your portfolio, how it should fit in, how you should think about it. At Creative Planning, we can help you with that and more. We do everything all in under one roof: taxes, estate planning, wealth management, and more. Over 300 billion in assets under management and advisement. We're in all 50 states. We likely have a location right near you. So reach out today, creativeplanning.com/Charlie. Schedule a 15-minute call. We're here to help. Number 4, Jamie Dimon on buybacks and credit spreads. Jamie Dimon, CEO of JP Morgan Chase, always has interesting things to say. And this week, he was talking about buybacks. And he said, I want to make it really clear, we're not going to buy back a lot of stock at these prices. What prices? He's really talking about valuations. He's saying buying back stock of a financial company greatly in excess of 2 times tangible book is a mistake. We aren't going to do it. Where's JP Morgan Chase trading now? 2.4 times tangible book. So clearly he's saying stock's gotten a little rich here. You can see the huge run up that it's had over the past year. This is kind of interesting because he was also talking about the same time kind of a valuation metric in the credit market, saying the investment grade credit spread, which is almost the lowest it's ever been, will be dead wrong. It's just a matter of time. And I don't know if he saw my tweet, because the day before he said this, I tweeted this out about investment grade corporate bond spreads being at their tightest levels since September 2021, 0.88%. What this essentially means, if you're buying an investment grade bond, on average, you're getting 0.88% above the yield on risk-free treasury bonds. He's saying that's not enough, and that's going to be a problem for buyers today. I guess he's saying that credit spreads are going to widen from here, or you're not getting good value. So a little bit of complacency we're seeing, not just investment grade bonds. I talked about high yield bonds a few weeks ago. So we're seeing this across the board, and in volatility, this kind of confirms it. Kind of the two are very correlated. When you see low bond spreads, it means people are expecting fewer defaults, and you tend to see less volatile environment for the stock market. And the VIX this week actually closed at 11.86, which is the lowest close since November 2019. So lack of fear in the credit markets, lack of fear in the stock markets. All news seems to be good news, with that AI narrative and corporate earnings in the US really driving a lot of that. Number 5 here, got to talk about very quickly. Roaring Kitty is gone almost as quickly as he came. He's exited here. A week ago, I was talking about this meme here, which set off another real mania that lasted only a few days, but he tweeted this out. Leaning forward in the chair means that the gamer is serious. That set off a craze. GameStop, AMC, all these other stocks going crazy for a few days. But less than a week later, he tweets this out, this video of from ET, and he's got the song Goodbye Stranger in there, essentially saying, I guess he's gone now. Again, he hasn't tweeted since then. So, what happens in terms of the meme stock mania? Well, last week we're talking about in 2 days, it went up GameStop from about 17 and a half to over 60. And then it comes right back down. And now it's, as I'm talking here on Friday, it's almost back to where it started. So it's kind of unbelievable that this time around how quickly it's transpired, but not unexpected because nothing fundamentally in GameStop changed over this period of time. The only thing that changed is this herd behavior and speculation. So until something fundamentally changes for the company, you shouldn't be expecting, of course, these types of gains. It's only a matter of time if you have this type of media where it comes back down to reality in the long run. The market's a weighing machine. In the short run, as we saw here, it's a voting machine. Can this happen again? Of course it can. You could always have this herd behavior. No one could predict it. But if you're a long-term investor, very much you should don't think ever of trying to participate in this because you can't time it. No one can get that timing right. And as I talked about last week, a lot of people piling in, obviously, at the exact worst time. And now they're paying the price once again for that. So number 6, trouble at Target. And last week we were talking about Walmart, very good earnings there. And we talked about some of the higher end consumers really starting to go to Walmart more. And that wasn't necessarily a good sign for the economy or consumer because it means that they're getting stretched and they're trying to go to Walmart to get discounts. And Target, not known obviously as a high-end store, but not as much of a discounter, I guess, as Walmart. Another difficult earnings report from Target. So shares were down about 8% after the report, and consumers are buying fewer groceries, home goods, discretionary goods. Soft trends were noted. And interesting here, Target saying that it was cutting prices on thousands of everyday items: milk, bread, paper towels, diapers. So trying to get people essentially to do what Walmart's doing is put these prices down so low that you're getting that increase in demand. You're getting consumers to come to your store for those grocery everyday items. If we look at Target's year-over-year revenue growth, down 3%. 3 out of the last 4 quarters, you have negative year-over-year revenue growth from Target. So just another data point that's showing consumer, we're starting to see more and more of this evidence of weakness piling up. So we'll see if this continues over the next few months, but definitely something to watch. We're seeing it in companies like Nike. We're seeing it in Home Depot. And we're seeing it now in companies like Target as well. So kind of across the board in terms of consumer spending, consumers still very much spending on travel, entertainment, but in terms of goods, in terms of retailers, we're seeing definitely the biggest pullback we've seen in some time. Okay, I want to end as we always do with something positive, and that would be the great start to a year for the U.S. equity markets. No one was predicting this coming into the year. We're already far and away above most of the analyst expectations for the entire year. I'm showing you here the best S&P 500 performance through 98 trading days. You can see here 2024 up 11.6%. That's a price return, and 19th best going back to 1928 here. And you can see here, look at the top 20, none of them finished the year down. So unlikely that we're going to see a decline that takes us lower. Not impossible, but unlikely. And you can see most of the years we continue to see gains through year end. Not every year. You have 87, of course, 1933, and you have 1943. But with the exception of those, stocks actually grew on those gains to end the year even higher from this standpoint. But where are we compared to the average year? Showing you here the average since 1990 total return is this blue line here. The green line is where we are today. So well above average. I think average at this point is total return is up around 4.5%. And today we're up 12% year to date already. So very strong start to the year for the S&P 500. And you can see here globally, most stocks stock markets are higher globally. S&P 500 once again outperforming. This is kind of unbelievable. We're seeing this each and every year for the last decade almost. S&P 500 outpacing the average country. Looking here, total world up 9.3%, S&P 500 up close to 12% year to date. So very strong year for the stock market year to date. Definitely good news if you have stocks in your portfolio. So we'll end with that. Thanks everyone for joining me. Have a great Memorial Day weekend, and I'll see you next time on the Week in Charts.